I joined Orion 1 year ago after 23 years with AECOM, most recently as its chief executive of the West region. And Scott, who joined at the same time, came to Orion with 30 years of corporate finance experience. We quickly formed a strong partnership and got to work fixing the company's profitability issues and maximizing the potential of the business. We've covered a lot of ground in the last year. We are now starting to reap the benefits of what we've accomplished thus far. More on that later. One of the things that attracted us to Orion is that it had a great reputation in the marketplace for handling complex, mission-critical infrastructure projects in the marine and building sectors. Orion's expertise led to long-tenured relationships with impressive clients across many government agencies in the private sector. Both Scott and I are committed to operational excellence and are making changes to improve profitability and shareholder returns. Our first goal is to improve margins through disciplined bidding on projects that require Orion's expertise. Instead of losing money, we believe that the concrete segment should be generating EBITDA margins. It's not yet. Oh, well, I guess, yeah, you got it. Sorry about that.
That's all right.
Instead of losing money, we believe that the concrete segment should be generating EBITDA margins in the high single digits, and the marine segment should also improve and deliver low double-digit EBITDA margins. While we are still in the early innings of our long game, we are making solid progress and are very excited about the future. Decades of construction excellence is Orion's currency in the marketplace, and that's invaluable. Our oldest legacy company has been successfully operating for over 80 years. We are fortunate to have the most exceptional people in the industry and two businesses with different catalysts for growth, concrete more driven by the private sector and marine by the public sector. They can balance one another during challenging times. When both are performing well, as we expect in 2024, we can deliver dramatic growth. Backlog is a key indicator of the health of the business, and we've more than doubled our backlog to $878 million, and on top of that, another $40 million in awarded projects at the end of quarter 3. We expect to continue growing our backlog. We believe we offer investors an extremely compelling investment opportunity. We're a mission-critical specialty construction provider with sustainable competitive advantages. We have a management team focused on bringing discipline and rigor to the business. We have large market opportunity with strong tailwinds, concrete driven by strong demand in the Dallas and Houston markets, marine driven by federal investment in infrastructure, coastal restoration, and port expansion. We have a diversified revenue base with top private and government clients. We're executing against a 3-point strategic plan to deliver improved financial performance. We've successfully executed against this plan and accomplished a lot in the first year, but we've just scratched the surface of the opportunity. Our sustainable advantages include the mission-critical nature of our projects to the economy. Shipping channels need to be dredged. Marine construction requires special expertise and equipment, as does commercial building, where foundational integrity relies on complex concrete work. We have long-tenured relationships with our clients across the government and private sectors in both our marine and concrete segments, including the U.S. Navy, Army Corps of Engineers, many of the largest ports in the U.S. and the Caribbean, major petrochem owners, and significant general contractors in the Dallas and Houston markets. There are high barriers to entry given the capital intensity of building a specialty marine fleet. Jones Act certified equipment prohibits foreign competition in the U.S. market. The high stakes involved with complex concrete projects is one of the reasons we have a 90% repeat rate with our vertical construction customers. Scott and I come to Orion with deep experience in the construction industry. As I mentioned before, I spent 23 years at AECOM, most recently leading a $2 billion division with more than 7,000 employees, and had a lot of experience with turnaround situations there. I saw that Orion had problems, and I also knew that those problems were fixable. Scott comes to Orion with significant experience in construction and aerospace industries. He has expertise in leveraging data and technology to help make better decisions and drive better business outcomes. We've made leadership changes throughout the organization. We appointed a new EVP of concrete, as well as attracted new talent. We recruited a director of operational excellence to develop our people and our practices, a leader of corporate growth and strategy, and several business development leaders across the organization. These leaders and others are driving change and improved performance throughout the business. Both of our business segments are operating in markets with strong tailwinds and opportunity. Marine, we're capitalizing on industry dynamics such as the $1.2 trillion infrastructure bill, the U.S. Navy investments in the Pacific, port expansions and maintenance resulting from the expansion of the Panama Canal, coastal restoration in Louisiana and other areas that are impacted by climate and damaging storms. And in concrete, we're experiencing strong construction demand in both the private and public sector of the rapidly growing Houston and Dallas markets. Our marine segment delivers world-class marine construction solutions throughout the U.S., Western Canada, the Pacific, and the Caribbean Basin. Our operations include construction, design, and specialty services for marine structures, specifically marine transportation construction, commercial diving, pipelines, environmental structures construction, dredging, and other marine specialty construction services. We are leveraging Orion's highly respected reputation and additional business development resources to identify new opportunities in the public sector at the federal, state, and local levels, including port expansion projects, Navy facilities, and environmental and coastal resiliency projects. We were awarded a $435 million contract to the U.S. Navy to build a dry dock at Pearl Harbor as part of a joint venture. This is the largest contract in the company's history and has the high potential to lead to follow-on work in the Pacific. More recently, we were awarded a $120 million contract for Grand Bahama Shipyard to build 2 dry docks capable of lifting the largest cruise ships in the world. The Infrastructure Investment and Jobs Act will provide a multi-year catalyst for public sector projects, such as transportation funding, ports, waterways, water infrastructure, and bridges, among other things. While we're excited about the potential to see significant opportunities in this space in the long run, the government has been slow to release funds. We believe there is significant pent-up demand to begin major projects on top of significant growth opportunities. We expect to see a ramp up in volume in 2024 and 2025 and beyond. And the investments we are making to expand our fleet, improve fleet efficiencies, our systems, and our teams will enhance our competitive position. Our concrete business has been an established player in Houston and Dallas markets for over 40 years. We've built a reputation as a high-quality provider. Our ability to deliver outstanding infrastructure concrete services is the main reason we have a 90% repeat business rate. We have great relationships with general contractors in these markets. Our partners have absolute confidence in the strength and reliability of our team to deliver. The type of work we do is complex and requires an extensive amount of expertise. Our work is categorized by structural and commercial, where we build large 1 or 2 story buildings where we cover a lot of square feet, warehouses, industrial, manufacturing, data centers. Many of these projects are 20 or 30 acres under one roof. The structural side is where it's more of the larger multi-story buildings up to about 45 stories. When Scott and I came on board, the concrete business had been losing money for too long. We implemented disciplined bidding processes, made leadership changes, and added more rigor on project delivery. We've also changed our approach to the type of clients we want to work with. Instead of a shotgun approach and bidding to win work at any margin, we're focused on clients that understand our value proposition and are willing to pay better margins. Demand in Dallas and Houston markets is strong. In March, we reported our first month of adjusted EBITDA profitability after 2 years of losses, and that trend has continued. We are now profitable on an operating income basis. We have long-tenured relationships with blue-chip clients across federal, state, local, and private customers in both marine and concrete segments. Our marine business has been very successful working on both public and private projects. By leveraging our experience elsewhere in the business, in the public infrastructure construction market, we'll be able to penetrate this more predictably funded sector in our concrete segment as well. Shortly after we joined, Scott and I quickly evaluated where Orion excelled and what needed to be fixed. We developed a plan to enhance profitability and generate better returns for shareholders. The first step, as I said earlier, was to fix the profitability of the concrete business. We took steps to implement more disciplined bidding processes that have resulted in higher margin projects in Dallas and Houston. We made the decision to exit the Central Texas market, which included the hyper-competitive Austin market that resulted in way too many low-margin projects. The changes we've made have worked, and we expect continued and improving profitability in that business. Next, we needed to strengthen business development to drive growth. We appointed new leadership to lead the concrete segment. We recruited top talent to lead business development in several markets, and another executive to lead corporate growth and strategy. We're also investing in training and tools that allow our people to reach their full potential. This is an important step in strengthening our culture, leveraging best practices, driving synergies, and cross-selling capabilities. We took a number of steps to strengthen the balance sheet and improve liquidity. We de-risked the business by securing a $103 million credit facility in May. We're optimizing to improve our return on assets. We've disposed of underutilized equipment. So far, we've monetized $25 million of non-core assets, with substantially more planned. With a stronger balance sheet and improved liquidity, we'll make necessary investments in our marine fleet to meet future demand. Now I'll turn the presentation over to Scott to cover our progress against our strategic plan and discuss our financials.
Thanks, Travis. Travis just walked through our plan for enhanced growth and returns, and this slide highlights the progress that we've made against that plan in just over a year. Exiting our unprofitable Central Texas concrete business has eliminated a major distraction and allowed us to focus on Dallas and Houston, where we are seeing good results. Demand continues to be strong in these markets, and we are winning work at attractive margins. As Travis mentioned, we turned the corner on concrete profitability earlier this year, and we expect to continue this trend, increasing margins in this segment as we realize the benefits of our operational process improvements. On the business development front, we've made changes and additions to leadership as we implement a more proactive and strategic BD process. By focusing on building client relationships, we will gain insight into opportunities early in the development cycle, instead of just responding to RFPs when they hit the market. With deeper client relationships, we can leverage our engineering and construction expertise, and our understanding of their needs will put us in a good position to win more work. Our improved targeting and bidding approach is already resulting in a growing backlog of profitable projects. And this strategic BD process will help us continue to win a bigger share of the large number of opportunities in front of us. We also expect to see more opportunities for revenue synergies between our segments. We've been working to break down siloed walls between our groups and get everyone together on one team, speaking the same language and focused on the same goals. Cultural changes don't happen overnight, but our teams are embracing collaboration, and for the first time, our segments are joining together to pursue projects with both marine and concrete components. The third prong of our strategy is to invest in our people, processes, and our equipment to drive growth. To be able to do this, our first order of business was to refinance our debt and monetize some non-core assets. Through our financing activities and dispositions, we've shored up the balance sheet and created more liquidity, and we now have the dry powder we need for working capital and near-term investments, such as upgrading our dredging fleet and our IT systems. We're focused on realizing our many organic opportunities, but we do operate in a highly fragmented market of many small regional players. And so we are keeping our eyes open for possible M&A opportunities to pursue geographic expansion. Now turning to a financial overview of our company. Orion achieved its high water mark for adjusted EBITDA in 2020. When the pandemic began, Orion had a solid backlog, and because the work was considered essential, We continued working through 2020, delivering those projects. But due to the slowdown and the shutdowns and due to the shutdowns and the delayed investment, the decisions that resulted from the economic uncertainties, the company wasn't able to replace that backlog as it was worked off. At that time, management was focused on maintaining the top line, and as a result, they went down market in the concrete segment in particular, accepting smaller projects with lower margins and higher levels of risk. Those decisions then came home to roost in 21 and 22 when Orion had to execute that low quality backlog, resulting in job losses and reduced profitability. Since Travis and I joined in late 2022, we've shifted our sales focus. Last year, as you can see on the bottom, the concrete segment produced the majority of our revenue, but only a third of our EBITDA. As of the third quarter of this year, our backlog has shifted dramatically, with our more profitable marine business representing 75% of our backlog, which has nearly doubled. Moving to this year, our first quarter losses resulted largely from cleaning up and completing most of the low quality, low margin backlog. Since then, we've realized steady progress and improved results from executing our strategy. We turned our $4 million EBITDA loss in the first quarter to positive $4 million in the second quarter and increased again to $9 million in the third. Our concrete business is making consistent profits, and our marine business has built record backlog and continues to execute well. This rapid improvement validates what Travis and I learned pretty quickly after joining Orion. We have all the pieces necessary to build a great business. All the company really needed was a blueprint. And the good news is that it's not really rocket science. It's as simple as pursuing the right projects at attractive margins and executing them well. It's still early in our turnaround, and we still have some low-hanging fruit to get. We've also got some opportunities that will take more time to implement. But we expect continued progress and an upward trend that continues into the future. Finally, I mentioned the work that we completed earlier this year to extend our debt maturity and adequately capitalize our business. With this accomplished, we have a low net leverage, a long runway, and sufficient liquidity for investment in our plentiful growth opportunities. Our markets are primed and ready with billions slated in infrastructure and defense spending. And with limited industry capacity and high barriers to entry, we expect to be well positioned to grow profitably. And we have ended a little early, so we have some time for questions if anyone wants to ask.
Questions from the audience? I can start it off. You guys did a great job. You mentioned 2 big contract wins, one in Hawaii, one in the Bahamas. How do you mitigate the risk with those large contracts?
I think it comes down to, in both situations, those 2 projects, we had the ability to negotiate good contract terms. Actually, I would say great contract terms with not only vendors and suppliers, but also with the owner, or in the case of Bahamas, and in the joint venture in the case of the Hawaii project. We worked really hard because of how you negotiate at the beginning with the contract is a lot how the project goes. So I think we limited or mitigated a lot of our risk by setting up the project well for success through the contract period. We also did things through the bidding process, like really thinking through what the risks were on the project, establishing a risk register, putting in a strong contingency for the risk items that were in there to build and protect ourselves in case something happens. Usually in construction something does happen, but we built a good strong contingency into those projects.
Okay. And on the concrete side, obviously exiting the Central Texas market, was a big push in the right direction in terms of getting some positive operating profits out of there. how else, as you look forward, do you see expanding the margins? You mentioned you think they should be in the high single digits in that sector. What other steps can you take to drive those margins higher?
Yeah, we talked about some of it during the presentation, but one of the key things was how we bid the projects, putting the right margin in to begin with. You can't set up a project, when you start a project with really thin margins and no contingency, you're setting yourself up for failure. And so we work really hard to make sure we establish, the right bid margin at the beginning, put the contingency in that we need on the projects, and then execute flawlessly. One of the problems we had as a company was we didn't execute flawlessly. We had a lot of self-inflicted wounds that hurt us in the concrete business. I think we've worked really hard to improve our delivery and everything from checklists and things like that as we're going through projects, giving our project managers the right tools they need to deliver the projects. It's making a big difference in our ability to deliver at higher margins. And some of that is, still to be seen as we improve the business. But it's we have a lot of work, or a lot of room to continue to grow margins by delivering better.
These are, and I may have missed it in the presentation, do these businesses complement each other, or are they simply separate businesses?
That's a good question. When we came in, they were entirely separate. They didn't even talk to each other. It was shocking, quite frankly. They are working together. We have them working together on projects. The marine business, for example, pours concrete on many projects. So we brought the concrete side of the business in to help pour some concrete, place rebar. Instead of our marine business calling up a competitor to rent a concrete pump truck, we're using our own concrete pump trucks, things like that. So we are. They definitely do appreciate that. Good question.
And I think we've only really started to tap into some of the synergy potential between the two businesses, because there's a lot of shared capabilities that are useful on projects that we're bidding out. Yes?
Are you guys experimenting with nanomaterials for the concrete mixture?
We typically are using concrete mixtures that are provided by engineers and through the process of design. So we're not developing concrete mixtures. We're using what is prescribed in the plans and specs typically. We have talked about that a little bit, but it's as of now we're not. I'm a structural engineer, so I'm pretty familiar with what you're talking about, and we're not, because of some risk factors and things like that. We're not proposing it at this time.
You mentioned some monetization of some non-core assets, and we know that you had a big real estate sale that had kind of been delayed or fallen through a couple of times. We thought maybe you could give us a little more color on where you stand on that and where you think that might end up.
Yeah, so Joe's referred to, we have a large industrial brownfield site on the Houston Shipping Channel, about 350 acres. That's we've been working on selling for a little while. The last deal fell through because of financing issues. We are in negotiations with a cash buyer and expect to have that deal done in the not too distant future. So we're making good progress there. That's about let's say $30 to $35 million piece of property. So
Which isn't used in our business today.
it's not used, and we'll use it for funding our growth.
1 minute, Joe. Any other questions for anybody? Okay, I think great job, guys. Appreciate it. Thank you much.
Thanks.
With more than 6,000 small and micro cap companies listed, if you're looking for the next Apple, then Channel Check truly is your tree. It's an investor community where you can access independent Wall Street research, advanced market data, balanced news, corporate videos, and podcasts. You can even register to attend in-person Meet the Management Series lunches, and to be part of the preeminent annual Small and Micro Cap Investor Conference, NobleCon. And here's the best news. Since Channel Check is sponsored by the featured companies, premium membership requires no investment. It's absolutely free. So check it out. Log in today. Find out why Channel Check is North America's leading source of research on the companies that just may change the world.